Okay, you can start now.
Hi, good morning, everyone, and welcome to the panel discussion on responsible AI. Broadly, this panel will be around 45 minutes. The main discussion will be around 30 to 35 minutes, and we'll keep aside 10 to 15 minutes to address any questions from the audience. So please do take the time and the opportunity to pose some questions for the panelists. Firstly, let me start by introducing myself. My name is Sam Kumar. I'm the Global Head of Analytics and Data Management at Standard Chartered, and I'll be the moderator for this session. Today, we've got a very exciting panel ahead of us. I'm joined by four people that collaborate together on a regular basis. But what they'll also be bringing is a very unique and a personal perspective as to how AI is used, how it could be used, and more importantly, how they collectively believe and individually believe that AI and its application can be held to a higher level of fairness. So let me start firstly with introducing Vishu Ramachandran, who's the Group Head of Retail Banking at Standard Chartered. Vishu has been at the bank for almost 30 years, but in that time, he's held quite a few senior roles. He's been a global product head, he's been a regional head of retail banking, he's been a CFO and a chief risk officer. But broadly in the bank, he's recognized as a very passionate, data-driven leader and is a strong advocate of the transformation that leverages digital data and analytics. Secondly, we have Mr. Mark Hookey, the CEO of DemystData. Now, DemystData is an organization that helps enterprises across the globe as a data partner to solve for their risk, process automation, and growth objective. Mark joins us today from the United States. So, Mark, thank you very much for extending your day to such a late time to participate in the panel. The third member on the panel we have is Anupam Datta, the co-founder, president, and chief data scientist at Truera. He's also a professor at Carnegie Mellon University. And Anupam's focus very much has been on accountable data-driven systems that employ machine learning and other statistical and artificial intelligence methods. His work has also very much touched on aspects such as privacy, fairness, compliance, and security. Anupam is also joining us from the United States, so a second big thank you for extending your day and participating in the panel. The fourth member of the panel is Shamik Kundu. Shamik is the Chief Data Officer at Standard Chartered Bank. Shamik is recognized as an industry leader in data and analytics, and he's focused very much on responsible adoption of AI in Standard Chartered Bank. He works very closely with multiple regulators as part of his role in the adoption of responsible AI, and he's helping to shape some of the emerging regulatory guidelines and the principles that are currently in development. So, welcome to all of you, and thank you for making the time to come on the panel today. But before we get into the questions, I thought maybe I could just set a little bit of context for the audience before we get into the deeper questions. Yesterday, I had the opportunity to be a member of the audience in a discussion between Satya Nadella, the CEO of Microsoft, and Bill Winters, the CEO of Standard Chartered, where they discussed resilience and the future of digital transformation. Now, what really struck me when listening to both of them having that discussion was just how critical the need to develop a differentiated customer experience has become in the last 5 to 10 years. And, it's a big dependency that's emerging on digital channels supported by data and analytics. And, these are now capabilities that are considered as existential in delivering on that obsession with customer experience. In particular, and more relevant to the discussion we're going to have today, is that they're both highlighted that currently many companies enjoy a trust surplus as a result of the focus they put on security, data privacy, transparency in the usage of data, accountability for outcomes from usage of data. But the belief is generally that the trust horizon will require a commitment to further continuous improvement in these capabilities with a heightened focus on the emerging area of responsible AI and data ethics in order to retain the trust in that future. In addition to this, of course, there's lots of data out there about the opportunity, the investments that are being made in AI, some mind-boggling numbers like $75 to $100 billion worth of investments in financial services every year, with the expectation of returning somewhere in excess of $1 trillion worth of new value in the financial services industry. Now, of course, it's a very heavy burden to put on artificial intelligence just by itself. But so clearly it's not a standalone capability, but one where there is a belief it has to be multifunctional teams and capabilities, including artificial intelligence, digital channels, user experience, client insights, marketing, product, value proposition, and risk all coming together to deliver a quintessentially differentiated customer experience. So with that context, what I'd like to do is perhaps just ask Vishu, firstly, the first question to you, if I may start with you. You lead a global retail bank with a very large and diverse client base across multiple geographies. And as someone that helps set and execute business strategy, how do you see banks leveraging AI as a key enabler and as, more importantly, as the custodian of our client experience? What do you think are some of the benefits and the risks that you foresee as adoption of AI starts to become more mainstream?
Thanks, Sam, and welcome everyone. And of course, special welcome, Mark, to yourself, Anupam, and Shamik. Let me take the three parts of that question, Sam. AI and ML has evolved, certainly as an enormously key enabler in the digital transformation of not just SCB, but of banks generally. We all face pressure to increase revenues, lower costs, and better manage risk. AI technologies, we believe, can support all three areas. When it comes to Standard Chartered, we are leveraging AI and ML across front office, across the middle office, and the back office, and specifically in 7 areas. We do leverage AI and ML across the client needs and assessment, across client authentication, through to AML and FCC, in the management of fraud risk, increasingly in credit underwriting, in credit collections, and in building out our conversational AI. So it's quite broad in its application. We see 2 risks. The first is the models and the algorithms are complex, and they're not always easy to explain how decisions are made. Thus, we do think an appropriate, responsible AI framework which sets out the guidelines for how it will be deployed are needed. And these need to be auditable, they need to be regulatorily compliant, and they, of course, need to be ethical, explainable, and transparent. The second risk we see, it's not a risk as much as a pitfall that companies like ours should avoid, is worth noting that the usage of AI requires ongoing investments. The technologies are evolving, and there's a risk that we create a perpetual cycle of legacy costs. On the benefits, I think we genuinely believe that AI holds enormous promise. We believe this will enable banks and companies like ours and across industries to completely redefine how work is done, how we create products for our customers and services, and how we truly transform customer experience. Indeed, it can completely transform an institution over time from the very core. It can unlock growth from the huge amounts of data that especially banks hold. It can automate functions. It can augment human working experience across more complex and creative work streams. So whether it's intelligent automation, replacing repetitive manual tasks, whether it's augmenting our staff with enhanced judgment, whether it's improved interactions and experiences for our clients, whether it is the creation of more innovative products, I think the use of AI will drive enterprise growth, will drive profitability, and will drive sustainability across the board with really a truly positive impact on the community. Back to you, sir.
Okay. Great. Thank you. Briefly, as you say, there are indeed some kind of emerging risks as a result of wider application of AI in financial institutions. Now, in your role as Chief Data Officer, you've had the opportunity to work quite closely with quite a few regulators over the last 2 or 3 years. And more importantly, you've also been part of working groups with regulators through which you've helped shape some of the emerging principles regarding AI. I think it'd be really good to get your perspective on perhaps 2 aspects of this. Firstly, is your perspective on the need to regulate AI, given that you've been actively helping to shape some of the guiding principles. And the second thing is perhaps for some of the audience members, is maybe just get out a little bit around the key objectives set out by the FEED principles in Singapore as a backdrop.
Thanks, Sam. So I think you rightly asked the question in two parts. First of all, is there a need to regulate AI? Now, the slightly controversial view to that question is no, there isn't a need to regulate AI specifically in the banking industry. And I intentionally use this as a provocative way of starting, because if you start regulating AI, I don't think you can actually get to any useful outcome. The use of AI is just a continuation of a long history of the use of predictive models in the banking industry, including a lot of the work that you do, Sam, and Vishu has done in his past, and people across the banking industry have done. And so there is an existing framework across all major banks around model risk management that should, for the most part, still stand good for AI, for newer machine learning based models as well. What we need to do, though, is to move the conversation away from that narrow, is the model doing what it's meant to be doing kind of conversation, which itself has some new elements, because as you use newer modeling techniques, that leads to some changes in particular. We need to include privacy considerations. We need considerations around transparency to clients around what is driving that decision. We need to think about how we take compliance requirements around making good use of their being trustworthy custodians of their assets as we go ahead and invest. So all of these things, all of these considerations need to be included into the broader governance framework. That's what needs to change. So it's less of a new framework for AI and more of how do you assess changes to the existing frameworks in a way that addresses the unique requirements from AI. So that's one part. In terms of the objectives, I think obviously one objective is, and the most important objective is to protect clients and to make sure that from a regulator's perspective, and make sure that they don't get disadvantaged because of the use of AI. There's an additional objective from many regulators, which is to promote the use of AI, particularly for financial inclusion. There's also considerations around making sure in certain regulations, certainly actually encouraging the use of AI as a way of rejuvenating the industry itself. But for me, as somebody working in a bank, I think there's only two things that are important. First, as you mentioned in your opening remarks, Sam, banks, the word banking on somebody is still meant to use, is still used to signify that you trust someone with something, right? And so the most important thing we as banks have is trust. And if we are unable to keep that trust, then we're going to fundamentally, miss out on the basics of banking in many ways. So the most important reason we should do this is not because some regulator is asking us, but it's because we are the repositories of trust from our customers, and we have a duty to maintain that. The second reason related to that is this is also an emerging and as of yet unarticulated customer need. I think this is actually going to be a source of distinctive value. Those who manage data and AI responsibly are going to be trusted more, and therefore will see themselves as emerging as winners in this industry.
Okay, great. Thanks, Shamik. So I think, look, Vishu, if I may just come back to you, I think what Shamik has highlighted is the fact that, look, controls, the need for fairness, transparency, etc., have always been part of our regulatory and our commitment to our clients. It'd be interesting to hear from you, perhaps, given that the Standard Chartered has been using machine learning for almost 5 years, how has Standard Chartered translated its company values to apply to AI adoption, and more importantly, ensuring that the technologies are used in a responsible manner? And I think just also building briefly on what Shamik has said about the FEED principles, what are you specifically doing, at the bank to test and apply those principles in order to foster a responsible AI adoption?
That's an interesting question, Sam. In our experience, the AI and ML models do tend to be more susceptible to issues with source data quality and interpretation, and are more difficult to understand and explain. While we acknowledge that AI can help us make better decisions and significantly improve client experience, what we also believe is that one of our three core values is is to do the right thing by our clients, and we are committed to using client data responsibly and being transparent about how we use it. And this is how I believe we ensure that our usage of AI and ML are in accordance to one of our most critical values. Our analytics teams work closely with Truera to ensure our ML models are explainable, are transparent, and are free of unjust bias. They support us, and this supports us in building a stronger and more sustainable business, as well as give confidence, and that's the critical thing. It does give confidence to both customers and regulators in the fairness of our data-driven processes and outcomes. Turning to your second question, regulators and policy makers globally are now engaged in crafting guidelines and standards to tackle the challenge and risks posed by ML models. Financial regulators in at least two major markets in which we operate, Singapore and Hong Kong, have introduced AI/ML guidelines in 2018 and 19, and many others, including in the UK, are likely to follow suit. These guidelines do help us guide us in building our own responsible AI framework. So I hope this gives you and our viewers a sense of both how we align the usage of AI and ML models to our values and how we are aligning ourselves to the regulatory developments in this area.
Okay, great. Thanks, Vishu. So, Anupam, if I may just turn to you briefly. Vishu has highlighted that you're a key partner in the artificial intelligence journey for Standard Chartered. Now, you've helped develop a lot of AI frameworks, tools, and processes to really supplement that journey towards responsible AI. But it'd be really good to hear from you. What does a company such as Truera actually do in terms of helping organizations, their data science teams, and more importantly, improve the business impact of machine learning at any organization?
That's a great question, Sam. And just building off of some of the comments from Vishu and Shamik, I would say there are two pieces to the story. One is building trust and enabling responsible adoption of AI. And that requires a deep set of capabilities embedded in software that can help various data science teams and other stakeholders assess the stability of models, their fairness, be able to explain them to various stakeholders, and in general, a rich set of capabilities to both build confidence, to use Vishu's word, that the models are going to be robust in production and deliver value to customers and to the business. And at the same time, making sure that guardrails are in place to ensure that harm is not caused through unfair bias, just prudential harm as well if the models start degrading in their accuracy. So that's one pillar and a key part of our engagement with Standard Chartered, Vishu's organization, your team, Sam, and other parts, other folks at Standard Chartered. The second piece, and this may be not as obvious, is that the use of these kinds of automated software platforms can actually help deliver better models faster. And by that, I mean, if you think of your first line teams who are building models, let's say for credit or marketing, the kinds of use cases that you have touched on in your earlier introduction, then being able to quickly identify where the blind spots in the models are, and then get guidance on how to address that, maybe through the acquisition of additional data. And Mark will have more to say on that, or through adjustments, data quality assessments in a more directed way, getting guidance on where you might want to retrain with additional constraints to eliminate certain kinds of weaknesses in the model. So that process, having tooling to support the first-line model development teams that, for example, are in your org, Sam, can really speed up the process of building better models and add a lot of efficiency to the process. And then for the higher stakes models that do have to go through a model validation phase, there are similar benefits in both supporting a deeper evaluation to guard against potential harms, but also assess model quality quickly. The timelines can shrink from the order of many, many months to a significantly lower amount of time. And for you touched on it earlier, that Vishu's organization, for example, operates in so many geographies, and your team, Sam, are building hundreds of models. And if those have to go through validation, and each model takes a year to go through a validation process, the business cannot scale up. This is where, in some ways, being responsible and having the software tools to support responsible adoption also greatly adds to the efficiency of the business and being able to move these models into production faster and continue to monitor them, which is another important topic that we can return to. Back to you, Sam.
Sam, you may be on mute.
Just while we're waiting to build on what you've been talking about, Anupam, around the use of AI and data in these models, and the responsible use of AI and data in these models, they're inextricably linked. And you talked about the shrinking, the technology enablers that are allowing people to build ethical and responsible models. What used to take years now takes days and weeks. And so there becomes this opportunity not just to innovate, but also to look at the status quo. And I think Shamik's point on this was very interesting. Banks have already been doing this for decades. They've been building predictive credit risk models that may or may not have had latent issues of bias embedded within them. But now the optionality to re-look at that is allows people to accelerate the rate of innovation and the rate of answering the questions that we're asking here. Sam, I think maybe you're off mute now.
Sam, your audio is...
Yeah, your audio is not coming through, Sam.
Okay, is that better? Yes.
It is not, too quiet.
Okay. Look, I think as you covered, Mark, that passion for more data, different types of data is becoming, one of the key differentiators in having a great opportunity to personalize, to build a deeper level of kind of intelligence. Now, companies like yours, you literally have thousands of external and alternative data points that you bring into the analytical process, which I think has two key benefits. One is a deeper understanding of the client data, where the typical focus has been very inward-looking, the kind of data a company typically has about their clients. But more importantly, I think the access to external data is helping in the prospecting of new clients and getting more deeper insights on somebody you may not know very much about, right? Now that leads to, I think, two kind of questions. One, Hello?
Yeah, we can hear you.
All right, okay. So one is perhaps a little bit simpler, which is just because data can be used, should it be used? And the second one perhaps is a little bit more, I think, hard-hitting around responsible AI. Who and how do you think boundaries should be defined with respect to data ethics? And what should it consider, in your view, as they progress on defining and implementing an ethics framework?
Yeah, thanks, Sam. I don't know that the first one's particularly a simple question either. They're both really good questions, and by the way, there are many millions of attributes in our broader ecosystem that are available, and banks have millions of attributes internally, let alone millions of attributes externally that are out there. And the sort of the broad theme of both of your questions is, well, just because data's out there and it can be used, should it be used? And it's similar to the question on AI. Just because somebody can build a XGBoost, ensemble model with k-means clustering, should they? I think, first I'll step back, and the premise of some of the questions around ethical use of AI and data, I have some trouble with it. There's this overarching question that doing more of something means potentially being less ethical, and I would argue that really the basis of the two questions you asked, Sam, are it really depends on the use case. There are some use cases where banks are expected and morally obliged to use more data and use far more sophisticated algorithms. And then there are other use cases where it's exactly the reverse, where there's a direct trade-off between, quote unquote, getting creepy and what the customer expects of the bank and what the original data furnisher expects. So there are certain use cases like, AML obligations, fair lending obligations. Banks have a responsibility to know whether or not they're overextending somebody on credit within different regulations around the world. And so do they have an obligation to look at 500 data sources to find out that somebody may have lost a job? In a way, yes. Another one is fraud, protecting customers and their online platforms. How do they protect the entire customer base from potential bad actors? And then there are other use cases where, Sam, you mentioned targeted marketing and knowing what products somebody might want. And that's where it might be a bit more of a trade-off. It might be a bit more, well, the customer didn't expect me to really find out all of these deep things about them before I made them a proactive offer for a product. So the customer expectations and by extension, the regulator expectations of what is appropriate really heavily vary based on the use case. So the data is available, the technology is available, and banks can now implement solutions based on the data and technology. But the frameworks we're seeing our clients adopt, and to your comment, Sam, the boundaries that they're setting up are very heavily tied on what people are trying to do with it. So we're seeing clients build out registers of the universe of potential attributes of what they could know about a customer, and then having frameworks to have a conversation internally and with regulators to say, is this appropriate for this use case? Yes, no, yes, no, yes, no.
Okay, great. Thanks, Mark. Anupam, if I may just ask you a question. Look, one of the experiences that seem to be emerging with wider adoption of AI and machine learning is that it is very sensitive, or it has a very heightened sensitivity to changes in data. Yep. Now, if you look at this year in particular, just with what has happened in the first 9 months this year, the behavior of clients has fundamentally changed as has their need for financial products and services. Now, naturally, as a result of this changing behavior, movement to digital channels, changes in spending patterns, a change in risk appetite has had a ripple effect on the data universe on which all these AI and ML capabilities are built and run. Now, this has probably compounded that accelerated decay in predictive capability and may potentially lead to risks of incorrect decisions or incorrect recommendations. I was just wondering if you have some advice or some thoughts about organizations that are on the AI journey as to why one models decay or AI and ML models decay a little bit faster. Second thing is what to keep in mind in order to mitigate for the degradation. And Mark, I think just kind of leading on from the point you made earlier, it also perhaps would be good to get your perspective, given that, data changes at different speeds. The nature of data is quite different between internal data and external data, as to how you're partnering with companies and your partners to, work out a mitigation plan on the impact of their capabilities that use the data provided by DemystData. Yep.
Yeah, that's a great question, Sam. Machine learning models learn relationships from the data that they're trained on. And as you're rightly pointing out, some of these relationships may no longer hold as the world changes. And this is especially relevant now with COVID. Credit risk models are starting to potentially drift quite a bit, as are marketing models. First, I'll note that this is not specific to machine learning models. This is also true about more traditional models as well. However, the effects may be a bit more pronounced for ML models since they learn more complex relationships, and some of those complex relationships may be less stable over time. And a key part of organizational process and software infrastructure here to address this problem is to have ongoing model monitoring tools that can track various metrics that are indicative of the model starting to behave erratically. That coupled with model debugging and model recalibration in a timely manner, in a much more event-driven manner, rather than on a regular periodic cadence that you update your models every year or every 2 years, that's going to be a key part of the solution here. And this is a space on which the academic and research literature, along with software tooling and practitioners, have started really putting in a lot of effort. There's a good understanding of this problem. So that's another area to pay attention to.
Yeah, and as Anupam said, models pick up the relationships in data. Models also are often picking up correlation, not causation. So external data and even internal data that isn't used today can often be more causal than the correlates that people tend to include and use. And model drift, AI models and predictive models are less stable if they're based on correlated variables as opposed to the underlying causal variables. So there's we feel the external data ecosystem, they're opportunity to get closer to the root cause, which can mean that models can be simpler or as complex as they currently are, not insanely interacted across every dimension. And there's opportunity there to find simplicity among the noise, which is as old as credit scoring itself. Now, we are living in a year of major change where there's been shocks in the system. Models that have been working for a long time no longer work. An exogenous shock means that people need to retrain their models, and that means more use of external data. Like in the small commercial lending space, we're seeing many clients use more accounting transaction data as opposed to credit scores from businesses, because it represents, again, get back to that point, a much more causal, real, up-to-date measure of a business's health to see the last 180 or 360 days of actual cash flowing into and out of the business, as opposed to a credit score that may have been trained over 3 to 5 years. So there's an opportunity from that external data ecosystem, even if it's not using new variables, the same variables, but there's an opportunity to get a truer signal of what's really causal and mitigate the real risks of model drift.
Great, thanks, Mark. Vishu and Anupam, if I may just bring both of you on to the next point that I'd like to highlight is, Standard Chartered and Truera recently announced a partnership as a result of a proof of concept that was very much geared towards identifying unjust bias. I was wondering if both of you could just give a little brief as to, what was the purpose of the POC, What were some of the findings, and what do you now collectively anticipate doing in terms of moving forward and scaling up?
Sure. Anupam, if I go first, very quickly, Sam, Anupam and Mark have spoken about responsible adoption, use of data, model drift. We in the few we've been working with AI and ML models. I keep repeating that these models are complex algorithms. It is challenging to articulate how ML model decisions or ML model supported decisions are made. It's to help us achieve this that we have established a relationship with Truera, and we are very privileged, I must add, to be working with Truera and Demist, to work with them as they've developed software and a tool that will provide greater insights into how our ML model decision-making processes are being done. Their software, their tools are able to pinpoint the specific variables that influence a client's credit risk score and identify factors such as race or gender that could cause unjust bias. We've been working with Truera to critically review and assess the credit models that we've built, as well as our marketing models, using internal and external data and ML techniques. We've identified 3 distinct but related areas of collaboration. First is in the installation of their tool. 2 is a specific critical assessment of our models on an ongoing basis. And 3, helping us build expertise and use cases. Our partnership with Truera, we believe, will help us better explain and justify our models, support us in building stronger and more sustainable businesses, as well as, and I keep emphasizing this point, is as well as give confidence to both customers and regulators in the fair data-driven decisioning processes. Anupam?
You said all of that so much better than I could have, Vishu. So I will just add that it's been a pleasure to work with you and your team. Sam's team on the machine learning side has been a fantastic set of collaborators, and also Shamik and the Chief Data Officer side on the regulatory interactions with Vijay and the rest of the CDO team, and the second line model validation team. So it's really been a privilege to work on these topics throughout the machine learning lifecycle with all of you. Thank you.
Thanks, Anupam. So, Vishu, I think just kind of building on that a little bit, Standard Chartered, specifically in the last 5 years, I think if you take a look at the partnerships that have been built up, Standard Chartered is becoming increasingly well known for partnering with fintechs, startups, and big tech. Now, from a Standard Chartered perspective, one, why do we look to fintechs and startups? And the second thing is, what are some of the key criteria that you personally hold forward when evaluating, companies that are new to the domain that might be, a very valuable partner to us in the future?
That's a good question, Sam. Sam, we, as a bank and as a business in the retail side, we have been taking steps like many of our competitors towards becoming more future ready, more data and analytically led. And AI and ML do have a very key role in this transformation. I must confess it's been a tough and long journey. The criteria we normally adopt, and we try to be faithful to this criteria in the selection and identification of partners, are typically 3. First is we assess our gaps in our own capabilities that partners, whether fintech, big tech, or data partners, can fill. The second is we try and identify the best in breed firms that we can collaborate with, both technically as well as culturally. And the third is we do, and we learn continuously, is how do we target opportunities where the size of the prize is material, now or in the future. Ensuring transparency and explainability in our ML-based decision-making is not just a competitive advantage for us, but also, I think, as I've repeated in this conversation, we believe is the right thing to do by our clients. In this specific instance, Truera brings in the solution capabilities and the rich experience to ensure that our machine learning models are explainable and are free of bias. We're also making better use of alternative data to drive financial inclusion and improve the predictive part of our models across our footprint. Mark has spoken about this, and we believe many underbanked communities face difficulties in obtaining credit because banks lack the financial data that they need. And in many of our markets, these constitute our core endowment of customers. This is where DemystData's ability to seamlessly connect to multiple data providers and ensure data ethics around compliance, legality, and warranty to bring in the client's alternative data has been a very crucial enabler. We ingest this data into our models to perform as precise credit assessments as possible, which just improves the splitting of risk. These partnerships, I genuinely believe and hugely value, are great examples of how we collaborate with fintechs and startups to help us drive innovation within the bank and also deliver great experience for our clients. I hope that gives you some sense, Sam, to the question that you asked in terms of how we partner with fintechs and firms like Truera and DemystData.
Yep.
Hey, Sam, you've got a few
Thank you very
questions
much,
from the audience on the chat channel. If you are able to take a look there. Mark has been helping answer a couple of those.
Okay.
Maybe I'll take the last one, if that's okay, Sam. The most recent one. Is there a measure of how smart an AI is? Just like we have IQ tests. Okay.
Sure.
Yeah. Well, I'm sure there are scientific measures around the accuracy, predictive accuracy, the stability, etc. But I actually think the real test of an AI model is how acceptable it is and how useful it is in real life. And both those points are very important, right? So I know it's a bit of a side answer, but really an AI model that is clever for itself is no good. It's really no good for most of financial services. You want something that can be understood by the people, and not necessarily straight away, but if you really wanted to understand why this particular product was recommended to me, or why did I not get that credit decision, and not just you as a customer, but bank, our regulators, our partners, our stakeholders, society, that is a real mark of good and effective in its predictive ability, etc. More than how complex the algorithm is and how many layers are there in the deep neural network, etc. I think that should be a better mark of the maturity of the algorithm.
Yeah, there's a similar analog on the data side. I mean, many of our clients on average use 10 times more data because we take the friction out of compliance, ethics, contracting, and integration. But the fact that it's 10 times more, that it by itself isn't the goal. You know, more data and more complex algorithms is actually in some parts bad because it adds complexity into the system. But what it does end up enabling is many more deployments of AI use cases, which help customers at the end of the day. Banks are in the business of, and have been forever, taking data and resources and analytics and using it to deliver financial services to end customers. And analytics helps improve how banks do that. So the data that is fit for purpose for a given use case and can be explained to a regulator and can be explained when you look in the whites of the eyes of the customer and say, this is why this is in your benefit, which is something that's been happening as long as bankers have sat down with somebody and said, before I spoke to you, I looked at your shop and now I know who you are and I understand what business you're in, and tell me about, where you grew up and how you run your business and how I can be helpful to you. That's an analytics exercise that's happening inside a banker's head. AI and external data is just an at-scale implementation of that same dynamic. And bankers had that same ethical question for as long as banking has existed. They would, use the things they felt appropriate and win business when they did, because that's the customers valued that. So we're not seeing a new domain appear and a new moral quandary come up. We're seeing the scaling up of something that's as old as financial services itself.
Okay. Mark, thank you very much for that. Gentlemen, I think our time is up. It is now 10:46. So firstly, before we finish up, please allow me to thank all of you for your time and specifically for sharing your personal experience and perspectives. I think that's what really makes a difference. We have a strategic business owner, we have a chief data officer, we have a machine learning platform expert, we have a data provider. So I think each one of you have helped immensely in, I think, giving a different lens on responsible AI. So thank you very much. We hope the audience has enjoyed the session, and have a wonderful day. Thank you.
Thank you.
Thank you.
Thank you.
Thank you all.